Okay, it's not live. I mean, it's currently recording right now, but it's not going
I'm
anywhere.
live somewhere.
No, we're just
Live in
recording
studio.
live. Yeah, exactly. All right. Hi, everyone. Thanks for tuning in. I'm here with Megan McCormick from DeLapp Real Estate. And Meg had texted me earlier regarding the news about the Fed rate increases and getting lots of questions about that. So this is going to be kind of a reverse interview here. Megan's going to ask me questions, I guess, and will put me on the spot and see how I do.
Well, because I get put on the spot and I can either defer to you, which I do with most of my clients, or I just call you and say, hey, can we just talk about this and put it out? Because I would like the education and be able to educate my clients as
Totally.
It's all over the news. So the rates.
And when you sent me that screenshot, I mean, the thing that's happening right now, right, is a lot of people are just kind of becoming alarmist about what's going on, right? Because there are a lot of unknowns. We're hearing like recessions and rate hikes and housing crashes and all this stuff. And so I think it's really nice to be more of a calming educational factor and try to have real data. And so when you asked me to talk about this, I was like, let's just throw it up on a video and record it because more people will probably have the same questions.
Yeah. So I guess the biggest question is, what is the rate hike, the federal rate hike, and what does it mean for housing? Like, how does it correlate? When they hike the rates, do the mortgage rates go up? So I guess we can just piecemeal that down.
Right there, for sure.
What does it mean? What is it?
Yeah. So I had quite a few customers today who contacted me and they were like, oh my God, I saw rates went up by 0.75. How much is that going to impact my payment? So good news is take a breath because the federal funds rate is not the same as mortgage rates. So yes, so it's okay. So the Federal Reserve controls the overnight lending rate. So it's going to impact more what institutions are borrowing from each other, and credit card rates, home equity line rates, the kind of adjustable rates are more impacted by the Federal Reserve raising their rates than mortgages are. Now, that's not to say that there's no impact. So when the Federal Reserve talks about what they're going to do to help control the monetary policy and the economy, that's already kind of baked into what lenders are going to therefore do, adjusting their interest rates.
Okay.
So what does that all mean? So let's go
recession. What have we got going on?
Right. Exactly. So let's go a little bit back in history over the last couple of years. We won't go too far back. So when the pandemic shutdown happened in March of 2020, the Federal Reserve decided to dump a lot of money into the economy, trillions of dollars into the economy. And that was important for that period of time. And as an aside, I'm taking the emotional health kind of everything out of the COVID conversation. I know a lot of people were impacted, but just looking at it like specifically from economic terms only, the impact wasn't necessarily as long of a recession as the Federal Reserve kind of anticipated it to be, because Americans went back to work, right? Like we all changed our roles. New businesses happened. We picked up our bootstraps and figured out other things to do.
We went online in virtual meetings.
Totally, right. We kept doing business. And so you can see there was a little bit of a recession, but it was really only for a couple months. But then the government kept putting all of the stimulus money out and kept doing everything and stimulating the economy, which was important, but it created tons of demand. And at the same time, they arbitrarily held mortgage rates really, really, really low by buying lots of mortgage-backed securities. So rates dropped to under 3% for like 2 years, which is crazy.
Unheard of.
Yeah. So people had extra money, and they also had really low costs of borrowing debt. And so that created this huge surplus of demand for services and products everywhere across many industries. And so we're still at the same time, it was and is sort of still the pandemic, right? Labor shortages and supply chain issues and all of that, coupled with this extreme amount of demand, created really low inventory across a lot of industries. And one of the impacts was the housing market.
Right.
So we had lowest interest rate ever. Consumers had extra money because they were getting some of the stimulus offered by the government. Student loans were in forbearance, rent was forgiven, right? So like people could stockpile extra money. And then if you were renting and working from home, you're thinking, well, if I'm stuck in my house anyway, why am I not buying something? And if you already had a home, you're thinking, well, let's renovate this home, or let's buy a different home that's more suitable, or whatever. So now we're here at the beginning of this year, and that demand was still crazy, and the mortgage rates were still super low, and inflation started going out of control really across the whole economy.
Yeah.
The Federal Reserve steps in with that rate and they say, okay, it's time to make things more expensive to borrow money so that people are less likely to spend their money on things, and that we can fight inflation and bring the costs down. And so that's what they're trying to do. So the federal funds rate will continue to go up until inflation is under control. And we're all seeing inflation in our day-to-day.
For sure.
Groceries. I just bought like ham the other day or something, and it was like $16.99 for whatever
right? It's crazy. Yeah.
So we want that to come down, right? We want inflation to come down. So the housing prices in the housing market is then impacted because when the mortgages are sold on the stock market.
Yep.
So when the investors on the stock market are hedging all of their trades and everything that they're doing, and they know the Federal Reserve rate's going up, and they know inflation's happening and all of this, mortgage rates historically increase when inflation increases. So we saw one of the craziest jumps in rates that has happened in the history of mortgages, going from like the 3s, now breaking through 7% last week on a 30-year fix. And that's all to really curb the huge demand that's happened.
Gotcha. So
here we are.
Here we are. Does the amount that the Federal Reserve rate go up correlate at all with mortgage rates?
So the
number?
market will, so there is somewhat. So because all of the predictions right from the beginning of the year is that the Federal Reserve is going to do multiple rate increases.
Yep.
They came out and said it. They basically said, we're going to keep increasing the rate until inflation's under control, and we don't care how high it gets. That's how they're going to fix things.
Right.
So when that continues to be the message that's being generated from the Federal Reserve after their meetings, that's what the stock market reacts to.
Gotcha.
And mortgage rates are already kind of being preset because of that. So lenders are already baking in the fact that there's probably going to be even more Fed rate hikes in the future. So that's why we're seeing rates continue to go up. Now, when the Federal Reserve does what they say they're going to do, which actually is raising rates, they've said they're going to do that.
Yep.
Sometimes it actually calms down the mortgage market a little bit because the stock market likes predictability, right?
Right.
So the market's like, oh, good. Okay, this is what was supposed to happen. So rates sometimes actually settle down a little bit, like a couple days after the Federal Reserve meetings, which is really interesting.
Yeah.
But then they continue their climb. And sometimes they don't. Sometimes they go up a little bit. So it's really hard to predict, but it's not a one-to-one correlation.
Yeah, that's sort of what I was looking at. Now, I've heard, through the rumor mill and economists and NAR and all that, saying that they think it's going to hit 9 interest rates. Not to scare people, but I mean, that it's the rumors on the street, right? And that's what we're trying to calm down a little bit. Have you heard that?
I wouldn't be surprised. I've heard probably it'll take another 6 to 12 months to calm inflation.
Gotcha.
And because of that, I don't think it would be a shock to a lot of people if mortgage rates kept heading toward 10%. Yeah. So, and it's so interesting because when you look back through history, right? Yeah. There are plenty of decades where rates were above 5%, above 8%, above 10%, right? So we kind of just got used to mortgage rates over the last 10 years being under 5%. That's really not the historic average at all. So maybe this is just getting back to the norm.
Maybe, because when I bought my first house, it was 13.
Yeah, I just was speaking to someone and they had an 18% rate, so
Yeah,
it's interesting. So
it is.
there are loan programs now that are coming back into play that kind of were out of
Okay,
the picture for the
sure.
last few years, or really last over 5 years, over 10 years, which help with higher interest rates. So, but you want to be really careful. Yeah.
Okay, why?
So, what we're seeing now emerge in this market are adjustable rate mortgages and buy downs, interest rate
Yeah.
buy downs. And so the idea between or with those types of loan programs is that you're going to start off with a lower interest rate. Sometimes it's for 1 year or 2 years or 5 years or whatever, and then it's going to adjust. So I'm getting a lot of questions about that,
Yeah.
but it really is important to understand the numbers and understand the math, and especially understand how much the rate can adjust and what that payment's going to look like. A lot of lenders are kind of just using this really distasteful, I think, marketing scheme and kind of
Yeah.
say, like, oh, buy now, refinance later, you'll be fine.
Right. Yeah.
What if you can't refinance later, right? So, I don't like to be a doomsday kind of person, but like this is real money we're talking
Yeah,
about.
sure.
So, if your rate adjusts to 12% and you can't refinance at that point, you better be sure that you're comfortable with that payment if you're going to go with that type of a loan product.
Why wouldn't someone be able to refinance?
Guidelines for mortgages are always changing.
Okay.
And who knows whether interest rates actually will come down or when they will come down.
Yep.
And also just circumstances, right? Like, what if you lose your job in the future and you're not able to get a loan again?
Gotcha.
So there's different factors that are totally out of anyone's control too.
Right. There's just a question like that. What else? What other kind of questions are you seeing as far as mortgage rates go?
Well, I want to throw one back at you.
Yeah.
So, as far as housing prices, so like ideally, again, with this whole rising rate environment,
Yep.
the goal, as bad as it sounds, the government's goal is they needed people to back out of the market. There were too many buyers and not enough houses.
Yep.
And so, as crazy as it is, with rates going from sub 3 to now over 7, I mean, that can mean six, seven, $800 more a month payments for
Yep.
people. But there are still a lot of buyers out there. So the biggest question that I'm getting is, when are we going to see more inventory, and how is all of this impacting housing prices? So what are you seeing
Sure.
in that
So I have
regard?
a great example of I just put a condo on in Northampton, appropriately priced, which I think is key right now in this market, is to price it appropriately. So you want a good realtor to study the market. And we had in 3 days, we have almost 20 showings.
Wow.
So there's still buyers, right? There's
Wow.
still a ton of buyers. And the biggest question of that is it in an association that they can rent it out? So a lot of people are looking for investment properties. There's a lot of investors. A lot of them are, looking for a place to live. But so to go back a little bit, everybody's like, oh, we have a housing shortage, right? Not enough inventory. We actually had the same amount of inventory. We've just had an influx of buyers. You sort of touched on that. So it's not like we lost inventory. We just 3x the amount of buyers that were out there in the market.
Right. Right.
So it was a housing shortage for the number of buyers. So that was
Right.
also a misleading headline. So it's like, when
Right.
are we going to see more inventory? We're pretty much on par with what we normally have at seasonally.
Right.
We had some at the beginning of COVID. We went down. But we are actually, had a ton of listing appointments lately of people going, is it still a good time to list? Yes, the buyers are always looking.
Yeah.
There's always buyers out there if they're well qualified,
Right.
people that need to move or have to move or really want to move, they're going to move no matter
They're
what
motivated.
it is or what the housing market is doing. So buyers seem to see the change more quickly and adjust more quickly to the market than sellers. So sellers are like, well, I want to get what my neighbor got. Okay, your neighbor listed last year when they were getting 150,000 over asking cash.
That's a really good point.
We're not in that market anymore. We're
Right.
just that is
Right.
gone. So if you price your property appropriately, you should have no problem selling your home. The
Right.
houses that we are seeing a ton of price reductions or houses coming back on the market. What does that mean? That means that they overpriced it to start with, and that they're coming back on the market because sellers are going, well, I don't want to have any, repair requests. I don't want to do that. I want no concessions. I want nothing. Again, not last year. So we're going back to home inspection issues and renegotiating after home inspection and not waiving all the contingencies.
Right.
So we're back to sort of a pre-COVID traditional market.
Right. Which is refreshing in a lot of ways, right? Because it's crazy. I mean, it's really disheartening especially for buyers when it was just like, you have 30 seconds to see the house and you need to make an offer today and it can't have any contingencies. Yeah. So, but I think at the same time, it's still a strong market for seller. It is still a seller's market for sure.
Absolutely.
But it's just a little more reasonable now for buyers.
Correct. I mean, we're back to sort of like 2019 prices, and 2019 was a great market.
Right. That's exactly what I was just thinking about 2019. It just feels like very similar to.
Yeah. It was one of my best years in real estate. You know, it was such a strong and just nice market. And you got to know your clients and got to spend time with them. Yeah. As I'm sure you do. You know, now it was just the past 2 years, it's just been throwing stuff around. And, you know, you don't know how to do anything. You don't communicate with them very much. So
and I think that's so important as far as using professionals who have been in the market, are familiar with it, because now more than ever, I mean, when you're listing a house, you're really marketing it. So everything matters. Not that and I don't want to say it didn't matter before, but there were jokes, right? Like memes or whatever on Facebook of like a porta potty. And it was like, best offer due tomorrow. And it would be this really blurry picture of a toilet.
People were just using this to take a picture, right? So these agents were just like going in with their cell phone and going click, click, click. Right. You need a photographer, a videographer, you need drone pictures. You still need the virtual tours. You need to market.
Right. All of that is so important. Right. And posting in the right places to reach the right clientele and everything. Is so important. And then the strategy side of things too. It's like actually taking a breath and figuring out, is this the right time to move? Does this all make sense? What kind of house do you really like, so you don't have remorse at all?
And I think the biggest question is, what does this house mean to you? Is it your forever house? Because that's going to change the way you look at your lending and, you know, what you want to pay for it. You know, is it just a transition house? Are you going to be here for a year, 5 years, 10 years, a lifetime? And that speaks a lot to it as well. You know, is it the house that you love? There's a monetary value and an emotional value to a home.
Definitely. That's so true. That's so true. Yeah. Awesome. Well, thanks for doing this. I'm glad we could hop on and chat. And we went from the federal rate to other things too that are even more important. So it's always awesome to catch up.
Yes, and thanks for giving me part of your time, because you are one busy lady with not just the mortgage, but the 2 small children. So
I know trying to coordinate schedules.
Yeah, so thank you so much for making the time.
Oh yeah, always fun to have these conversations for sure, and helps each other. We can help each other. Gosh, I can't even say words. Speaking of having little kids and no sleep. All right, well, thank you, Meg.
Thank you.
That's a wrap. Thanks so much for tuning in to our Applied Mortgage Community Show. As always, if you have any mortgage-related questions, please contact our team at Applied Mortgage, 413-586-5626, or appliedmortgageteam.com. And if you want to be featured on one of our episodes, let me know. We'd love to have you.